Hello everyone, this is your host Dr. Hitosh Taya and welcome to Health Industry. So the topic of today we're gonna talk about is, I suppose, let's talk about investing and my investing journey so far. And let's start a new trend. We're gonna talk about the quote of the day. The quote of the day is from a little junior of mine. She invented it on her texts. And where is this? Where is it? When there is mental peace, we were talking about, I suppose, we were talking about, what were we talking about? Yes, we were texting about sleep issues, insomnia in general, people who have difficulty falling asleep. And well, she came out with a banger quote that I love. When there is mental peace, people ultimately fall asleep and a sense of satisfaction with whatever they have in their lives. Beautiful, right? She just wrote it on the fly. Let's just give another quote of the day. Courage is action against fear, and discipline is action against laziness or fatigue. It's a quote by Homozy, and that dude knows how to give quotes. He's awesome. Now, so investing. What is investing? It is in Hindi known as Nivesh. Investing is buying assets. That is investing, in which you use your money to generate more money in the future, hopefully. So the most common modality is used in India by middle class. Let's start there. So FDs, fixed deposits. These are deposits provided by bank. You take your money in bulk, 1 lakh, 2 lakh, 10 lakh. You give them to a bank, and they will just keep it there for a 3-year lock-in period or some lock-in period. There are FDs which can be broken immediately, but generally they have a lock-in period. So that are known as, and there is a fixed interest rate around 10%, 9%, 8%. I'm not sure it bleeds inflation even. Okay, let's talk about inflation and my understanding of inflation. My understanding of inflation is this. It is not my understanding, it is the general. For example, let's say the buying power of 100 rupees. There was a time where, it must have happened right before your eyes. The packet of Parle G, right, which used to cost 5 rupees, now costs 10 rupees. So what happened? The buying power of 10 rupees, which was capable of buying 2 Parle G biscuits, is now only capable of buying 1 packet of Parle G biscuits. So that is called as inflation, the decrease in the buying power of money. Now, how does this happen? So this happens. All economic concepts eventually boil down and break into the basic concept of demand and supply. So in this instance, when government prints a lot of money, the supply of the commodity known as money increases, and as the supply increases, the demand decreases because everyone now has more money. So why is diamond kind of expensive? Because it is rare. It is high in demand but low in supply. That's why its price is high. The same happens with, I suppose, our currency. And let me tell you, money market, understanding currency is a very, very difficult concept. I myself don't understand it. So let's ask someone who does. Let's just ask ChatGPT about it. Okay, so what are money markets? Money markets are a part of financial system where short-term borrowing and lending take place, usually for a period of 1 year or less. They are used by government, bank, and large corporations to manage short-term cash needs. Think of them like financial pit stops for parking or borrowing money for a short time. For example, includes treasury bills by government, which mature within a year, certificate of deposits by banks, raise short-term deposit, commercial paper, call money, I don't understand money market, but what I do understand is stock market, business analysis. Now I'm very excited to share my journey with you guys. So let me recall something. Okay, so the first time I invested in a stock, I don't remember if it was Asian Paints. No, it was HDFC Bank, right? The first stock I ever bought, HDFC Private Limited. It was amazing, right? The first stock only, I don't remember it, maybe 2000, 3000. No, and the initial stocks I bought 2 years ago were Bajaj Auto, right? I thought it was such an amazing feeling being the owner of these things, right? uh, Obviously one or two stocks. I was a kid with a little bit of money and I opened a demat account. Let me tell you how stock purchase works in general. So I'm going to break it down in a very simple explanation because I understand it very well. So what happens is that giant businesses were not giant to begin with. For example, there is one biryani shop. Eventually it can become a giant business with, for example, let's say McDonald's, right? McDonald's, there is just one burger shop. Okay, so what happens is this one burger shop is turning a profit, and he knows that he opens another burger joint, he's going to make a lot of money, but he does not have the money to buy that plot of land, the real estate, the cost of furniture, the cost of operations, the cost of hiring employees, the cost of training employees. It all adds up too much for him because his profit is constantly invested back into the buying more stock, selling more. Although it is a successful, profitable business, he just does not have the capacity to buy real estate and invest huge capital in opening multiple shops at the same time. So what he does is he raises money. How does that person who is operating a successful business in a single city raise money? So how he does it is that he first of all he opens a company. The company is now titled McDonald's Limited. And now what he does is he gets it audited by a business analyst. I think not all of my information is accurate, 100% accurate. This is just my understanding of these concepts. I'm just telling you guys what I think and what I understand, what I remember from reading this stuff 2 years back. So what happens next is the business analysts analyze it. Okay, so they see that let's suppose we're going to very simplify it. Okay, so the McDonald's burger shop is selling, let's suppose, 1 lakh rupees worth of burgers daily. That's, keep it simple, right? Say hypothetically they are selling 1 lakh rupees of burgers, fries, whatever. Total food sold is 1 lakh rupees including cold drink and everything, and they have crazy profit margin, 80% profit, 50% profit margin on food because of the beverages being very cheap. So let's say the 50,000 rupees goes straight into the pocket. That is known as gross profit, right? Gross profit is profit minus the cost of manufacturing good. Okay, so the manufacturing is covered. Now there is net profit. Net profit is after deducting further charges, for example the electricity bill of running the place, the employee cost, right? Paying your employees whatever, 5,000, 10,000, and then there is obviously advertisement costs, or if marketing costs if there are any. So that makes about, let's say, net profit being 30,000, which goes into the pocket of the owner of McDonald's of that particular area. So it is a business which is guaranteed to generate 30,000 rupees per month. It has real estate worth, let's say, 50 lakh. It has employees. It has a public image. A so-called public image is also a commodity. For example, Tata Steel. People trust Tata Steel because it is Tata Steel. So that itself carries a monetary worth. Let's suppose that branding, the branding of McDonald's is worth, let's say, 10 lakh as well. Okay, so 10 lakh real estate, sorry, 50 lakh real estate, 10 lakhs branding worth 60 lakh this, 30,000 per month profit per annum, let's suppose. Gross 13 to 12, 3 to just 6, 3 1 3, so around, yeah, fuck, my math is completely ruined. I was very good at oral math, but now I can't. Let's say 30,000 into, just multiply by 10, and then there's 2 months extra, so that is obviously 1 lakh, sorry, 3 lakh 60,000. 3 lakh 60,000. So let's suppose the net worth of that whole business is around, what was this? 63 lakh 60,000. That's how they do it. They pull it out of their head bucket, doing crazy economics mumbo jumbo. I'm not a mathematician. I'm not an economist. I am a doctor. So that is my so and so basic understanding of it. So what happens next is the crazy part. So not only is all of this analyzed of that business, what is analyzed is the future potential of that business is analyzed. How is the future potential of that business analyzed? Let's say he firmly believes that it is the first known burger brand that when he opened it immediately blew up. It is guaranteed that if, for example, it was opened in a city like Delhi, in a region of Delhi which has thousands of identical regions, thousands of identical population, and he's guaranteed that when he opens the another one is going to make the same amount of money. So what will happen is its future projections are great. So he's like, let's just believe that after he gets injection of fund, his future projections are gonna be, let's say, another 50 lakh over 10 years. So what ends up happening is we had it's projected around 60 lakh, right? 60 lakh something, 63 lakh something, right? Let's just double it, and now we have projected worth. Now this is called as the market capitalization. This is the concept known as market capitalization. So the current market capitalization of McDonald's, as per this reasoning in this study is 1 crore 20 lakhs. So that's how they do it. And now what happens is that company is going to issue shares. So he's like that my company is worth 1 crore 20 lakhs. Now I'm going to divide it in, let's suppose, 10 pieces for easier understanding. So what was it? It was whatever, 6 to the 12, right? 1 crore 20 lakhs, right? 1 crore 20 lakhs divided by 10 will be 0.1 crore, right? Maybe 10 lakhs again. So I have made 10 partitions of that net company worth. So we have 10 lakh plus something to each shareholder. Do you understand now? Now that, let's suppose there are 10 owners so if 10 investors want to come in and get equal portions of that company, then they would be doing investing this amount of money for this percent, that is 10% stake of that company. How much money would be? There is 10% of 1 crore 20 lakh something. So that is how a stock market works. And a stock market is a secondary market. So initially the company cut his company's market cap into, let's say, a number of shares. How many numbers of shares? The company itself decides it. For example, if it is my company, I would like to hold on to at least 60% of my company so that I can be the guy, I can be the main decision maker. So I will partition my company in such a way that I am the 60% shareholder, and then there is sufficient pieces of 40% left that I can sell to various parties, public, the international investors, the banks, the governments. I can sell my company to all sorts of people and get a lot of and raise a lot of money and still. So how many shares of a market are there? The way to find it is you take the value of one share, you multiply it by number of shares, and you will get market capital. If so, to find X, just divide the market cap by the share price, current share price, and you will find out how many number of shares are in circulations. But that is not really important. There are, and now, so this is the basic concept of stock market. Stock market is now the secondary trading of this. For example, the shares have been issued, the money has been raised. Now let's suppose a guy owns 10 shares, a guy owns 10 shares of this McDonald's. Suppose 100,000 shares have been divided and one share is worth now suppose 200 rupees. So that is the calculation that is going on, right? The worth of that company is determined by, I told you how. And now let's suppose the company sees a hike in their revenue because the brand value has become much more, the competition has declined, they bought out the smaller burger joints and now their burger is the predominant one. The cold drink company which was competing against them, for example Pepsi competing against Coca-Cola, they acquired Pepsi and they just kind of destroyed Pepsi, and Coca-Cola is the trending thing now. Something like this happened, and let's say the revenue of one joint is doubled, let's say from 30,000 net profit in his pocket, now he's making 60,000 net profit in his pocket. So the equation changes entirely. The worth of that company has expanded greatly because unexpectedly now that company is worth much more, because not only that one joint in that city experienced the increase in the revenue and profits, every joint is getting that, and now they have established a monopoly in the market, so they are the number one guy. The number one guy earns more than the next 10 guys. So what has happened is the share price of that stock should ideally rise. There is another element, the element of stupidity in stock market. So the element of stupidity and manipulation, I call it. For example, people jumping on bandwagons. A stock is rising, everyone want to buy it. It is called as the sentimentality of an investor. The fear of missing out, the psychological aspect of all of it. So there is an inherent randomness and stupidity due to the randomness of an investor and psychological actions. So because not everyone is completely rational, not everyone analyzes everything. Some people just buy stocks out of the general sentiment. Some newspaper praised them, someone recommended something to someone, some YouTuber publicized something because he bought it and he wants it to go up, so he will increase its demand. It all eventually boils down to demand and supply. If there is more demand of that share, more people place the buy order and less people place the sell order, the share price goes up. And if more people press the sale order, there is an order book, there are various order books, right? I press the sale order. If there is a buyer in the secondary market, then his shares will be exchanged for my money. So that is how all of it works. I could go on and on, talk about my personal finances, what I have done, what I have learned, but maybe another time. It's too damn hot and I need my fan. The fans are off. Why? To avoid the sound disturbance of fan. I don't have AC currently and it's damn fucking hot. Keep drinking water, study finances, because every man needs to have his finances in check. Health industry, always looking out for what's best for you. Peace out. Dr. Hitosh Daya, always looking out for you.